The Altria Group, ticker symbol MO, just paid me $304 in dividends. This is my largest individual payment ever from my long-term dividend growth stock portfolio. I reinvest these dividends to increase my future dividend income. This powers the dividend snowball effect. In this video, I'm going to explain the power of dividend reinvestment and whether or not I think Altria stock is a good buy right now. My name is Zach, this is Dividend Data, and you should leave a like and subscribe if you enjoy the video. I'd highly recommend you try out my stock research tool, which is available at dividenddata.com. This includes deep financial research for over 8,000 stocks. If the software helps you identify just one slightly better investment, then it pays for itself. Sign up and become a member at dividenddata.com. Link in the description and pinned comment. Also, I should mention that Dividend Data YouTube content is now available on Spotify. Please give it a follow and a good review to help spread the show. Now let's get back to the video. Altria stock is the dividend king, meaning the company has increased its dividend payment on an annual basis for over 50 years. The forward-looking annual dividend payment is $3.76. At current stock prices, that is an 8.36% dividend yield. It is a high-yield dividend payer with reliable, slow growth of both free cash flow and dividends. In my dividend portfolio, Altria is the top payer. It's projected to generate $1,273 in annual dividend payments. On July 10th, Altria just paid me $304.37. This is significant passive income, which I'm reinvesting to buy more shares of the company. That will increase my future dividend income, allowing me to buy more shares, creating a virtuous cycle. This is what us dividend investors call the dividend snowball effect. With my Altria stock, I already have 24.79 shares directly earned from reinvesting dividends. That's $1,100 in current value and an additional $93.21 in annual dividend income. This boosted my dividend yield on cost by 0.68%, giving me a 9.31% yield. That will only continue to grow as my latest $304 dividend payment will acquire at least 6.5 more shares. This is the snowball effect at work, powering a big part of your long-term total return. On top of dividend reinvestment, Altria has reliable dividend growth. Over the past 10 years, the dividend CAGR is 7.89%. This has slowed down, with the latest increase being 4.44%. Moving forward, the Altria Group CFO says investors should expect mid-single digits dividend growth. This is sustainable as the dividend payout ratio is around 80% of free cash flow. The combination of investing new capital, reinvesting earned dividends, and dividend growth has increased my Altria dividends significantly. Here you can see my full history of payments with the stock. My first dividend was $6.71 all the way back in April 2020. Now it's growing well north of a $300 quarterly dividend. It's not unreasonable to think that this will soon become $500, $750, $1,000, and so on. In fact, I built out a model on my website dividenddata.com to forecast out the impact of reinvesting dividends. I just entered the current stock price and dividend of Altria with a rather conservative projection for a 4% dividend CAGR and 6% stock price CAGR. With a one-time investment of $15,000, roughly modeling my current ownership and reinvesting dividends, the results are stunning. After 5 years, the total projected value is $29,585 with over $2,000 in annual dividends. At 20 years, the total value is $186,000 with annual dividends at $9,000. After 35 years, the total value is roughly $917,000 with $35,000 in annual dividends earned. That would be a 234% dividend yield on initial cost. This is of course assuming the given growth rates hold true. It also does not include taxes paid on your dividends. The reason for this huge long-term compounding is the impact of reinvested dividends. Just look at these graphs. In each, the gap between reinvesting and not reinvesting dividends is massive. This is because you are quite literally increasing your ownership stake in the company by reinvesting earned dividends. Just look at the step-by-step version of the model. Each quarterly dividend gives you more shares. Look at the growth of total shares over time. Starting with 333 shares, you'd be at 455 by year 5. By year 20, you'd have 1,200 total shares and earning 16 every quarter. This only continues to grow. A model like this is only as good as its inputs. In reality, it could vary dramatically and is highly dependent on the performance of the company. However, it highlights the true power of the dividend snowball effect, which is only revealed on a long time scale. So is Altria stock a good buy right now? Well, I think so based on its low valuation and reliable growth. I'm going to calculate intrinsic value using the dividend discount model, measured against a 10% discount rate over 35 years and a 4% dividend growth rate estimate. Then it shows the stock is about 20% undervalued. If I up the dividend growth rate CAGR to 5%, then it shows the stock is 29% undervalued. In my opinion, this is a large margin of safety where I think Altria stock is a strong buy. I will continue to add to my position and reinvest dividends around this current price range. If you've enjoyed the video, leave a like and subscribe on YouTube and a review on Spotify. Make sure to watch my latest portfolio update video to see my entire dividend portfolio. You can gain access to the stock research tool I used in the video by becoming a member at dividenddata.com. Link in the description and pinned comment. If dividenddata.com helps you discover just one slightly better stock, then it pays for itself. Thanks for watching.